Good evening to all. Today, this special lecture series program for undergraduate students is organized by Kolkata Bidhannagar Society for Academic Advancement and coordinated by Azure Academic Services. Today's topic of discussion is Indian financial system. Today, our guest lecturer is Sukanya Bhattacharyya ma'am. She is an assistant professor and department coordinator at Sister Nivedita University. With a background in commerce and finance, she has published extensively in national and international journals. She actively participates in faculty development program and is an annual member of KBSAA. Her research focuses on Indian financial system and markets. Welcome, ma'am.
Thank you. So I am presenting my screen and I'm starting
Th-
with my today's session. Okay.
Thank you so much, ma'am. Please start.
So is my screen visible?
Yes, ma'am. Visible.
Okay. So today my topic is Indian financial system. I'm Professor Sukanya Bhattacharya, Assistant Professor, Department of Commerce, Sister Nivedita University. Now to start with the Indian financial system, the financial system background is something which is very important for everyone to know. Okay. Now, what is financial system? The financial system is a set of composite and closely interconnected financial institutions, intermediaries, market services, assets, regulatory bodies, and is most significant institutional and functional medium for economic transformation. So whenever we are talking about any financial system, it refers to the interconnected systems of the financial institutions. Now there are different intermediaries. Who are the intermediaries? Intermediaries are those who act as a link between the financial systems. Now there are different financial markets, different financial services, different financial assets, and there are regulatory bodies who govern the entire financial system of a particular country. The entire interrelation of all those things are termed as the financial system. Now, financial systems are essential for the capital formation of a particular country. Now, why my financial system is important for the capital formation of a country? Because in the financial system acts as a platform where the interrelated activities of savings, investment, and finance leads to the capital formation. Now, what are savings? Savings are the excess of your income that you are saving, that you are keeping aside for your future requirements. Now, whatever money that you are saving, you are not keeping it in your home for a lifelong. You need to invest those savings into some financial assets so that you can expect a return from the amount that you are saving, right? So a part of the savings gets invested into the financial markets in form of the financial assets. Now, whenever we are making an investment in the market, that becomes the capital for any other business organization. And in this way, we can see that the entire savings and investment gets channelized into the finance, and thereafter it leads to the capital formation for the entire country. Now, let us look to some of the histories or to the backgrounds of these financial systems. Now, until the early 1990s, the Indian financial system was primarily restricted to channelizing the resources from surplus to deficit sectors. What do I mean by surplus to deficit sectors? Now, there are a portion of the economy where there is surplus availability of the resources, and there was a sector of the economy where there was a deficit. Now, the funds kept on moving from the surplus to the deficit sectors, where one place where there is resources to the one place where there was requirement of the resources. Now, this was the concept of the Indian financial system in early 1990s. Now, in the later stage, what happened? We saw there are several financial sector reforms that were coming up. Now, those financial sector reforms were initiated in 1992-1993. Now, this was a part of the entire process of liberalization and globalization. I'm sure that you all have heard about LPG. Now, what is LPG? L stands for your liberalization, P stands for your privatization, and G stands for your globalization. What do I mean by liberalization? Liberalization means liberalizing the trade restrictions. What do I mean by privatization? Privatization means allowing the private sectors to take a part in the sectors which were previously only handled by the public sectors. Now, under privatization, private enterprises were also allowed the ownership. Some of the public sectors were handed over to the private sectors, and this entire process was known as my privatization. And finally, globalization. What do I mean by globalization? Globalization means integration of the domestic economy with the world economy. So, with the advent of this LPG, the concept of liberalization, the concept of globalization led to the different reforms in the financial sectors, which initiated in 1992-1993. Now, they were almost aimed at promoting an efficient, well diversified, and competitive financial system. Now, the question comes to any reform is why? Why do we require a financial reform? Why do we require a change? The answer was very simple, that the Indian financial system was not well structured. We wanted our financial system, wanted the backbone of our economy to be a very strong one. Now, for that, we aimed at an efficient financial system. We wanted a well diversified financial system which not only looked into the movement of funds from the surplus to the deficit sectors, but an overall integration of the different aspects related to the financial system and an overall growth of our economy. Next, there was a competitive financial system. We wanted our financial system to emerge as a competitive financial system where we can stand as a strong financial system amongst the global financial systems. Okay, so with these objectives in mind, and with another major objective of improving the resource allocation in order to increase the overall efficiency of the system, the Indian financial system came up to the reforms, and it definitely had well established itself after the reform period of 1992-1993. As mentioned, the main objective was to create efficient and stable financial institutions and markets. We never wanted our financial institutions or markets to be inefficient or an unstable one. So the objective of creating an inclusive, a strong, an efficient, and a stable financial institution was to make a strong foundation for our. Next, the Indian financial sector had undergone radical transformations in 1990s. So, as I have mentioned in my previous slide, the process of my reform started in 1990s. In 1992-1993, with LPG, it had increased the speed up of the reforms, and thereby a competition has been fostered through equity or through the entry of private sector banks and the freeing of the deposits and lending rates of the interest. Now, financial sector reforms have helped to raise funds for the corporate sectors. Because there is a free flow of fund in my financial market, there is a free flow of capital in my financial system, which help the corporate sectors to raise fund, to raise capital, to carry on their business. Of course, if the corporate sectors, if the business sectors are raising more capital, they are having more money with which they can carry out their business activities. So if the capital, if the corporate sectors are getting money, with that they can carry out their production. If the rate of production is getting increased, the amount of goods and services that will be produced in the economy, that is also increasing. And if the total amount of goods and services produced in the economy is increasing, it shows that my GDP of the country is also increasing. And if my GDP of the country increases, in turn, we can say that the overall economic welfare of the country is also increasing. Now, with this, let us move up to investment and finance. In my very introduction, I have said that when we are talking about the financial system of a country, it is the interaction of the different elements. These elements are my savings, finance, and investment. Whatever income we are having, a part of it we are spending for consumption, a part of it we are keeping as our savings. Whatever savings we are having, we are investing those savings into some financial assets in form of investments. Now, when I am investing into some financial assets, it is going to the business sector, to the corporate sectors in form of finance. So the capital formation takes place as an interactive force between the savings, investments, and finance. Now, let us discuss about the role of finance in economy. We are talking about the Indian financial system. We are talking about the different interrelated activities that compose the entire capital formation of our economy. But why we are talking about all this? There is a role, an important and indispensable role of finance in our economy, and that is what we are going to discuss over here. The first role of finance is that savings are mobilized through finance. Now, if you are saving your money and that money is remaining idle, that is not going to make any impact in the economic growth. Only if your saving is mobilized, only if your saving is channelized into some investable form, then only we can say that it is leading or it is promoting our economic growth. Now, when my saving is mobilized through financial activities, how it gets mobilized? Your savings, that is the surplus sector, is flowing into the deficit sector. Deficit sector means what? The one who are seeking your fund, the one who are seeking your investments. Okay, so in this way, the saving mobilization can be done by different financial activities. Next, it basically makes a link between the savers and the investors by bringing them together. Now, again, if you are saving your money, it remains idle, it's of no use. So, there has to be a link. What acts as a link? The finance acts as a link between the savers and the investors. If you only save your money, it's of no use. When you mobilize your savings into investment, then you become investor, and then your money becomes finance, and thereafter it leads to the economic growth. Next, it obtains an adequate supply of capital for the need of the business in the financial system. Okay. Now, if we are talking about the business sectors and there is no one to provide fund to the business sectors, there is no capital formation opportunity for the business organization, then will this business organizations thrive in long run? Of course. Now, who will ensure this supply of capital? We. the people, we the individuals who through our savings are leading to the capital formation. Now, the finance acts as a lifeblood of any economy, and the financial system helps in the smooth channelization of this entire capital and keeps the business sector of the economy moving. Furthermore, finance conserves and increases the capital through better management. Again, it also assists the business enterprises in making a profit from the use of funds. Okay, now the business sectors have gathered the capital, have gathered the money, but they should know how to utilize this money, how to mobilize this money, how to use these funds in order to make profits. Now, finance is something which assists the business enterprises to learn to make a optimum utilization of their funds so that they can make a profit out of the available funds. Next, it involves the procurement and utilization of the funds so that business firms will be able to carry out their operations effectively and efficiently. Now, if there is an interruption of the capital flow in a business organization, the normal course of business, the regular activities of the business will also get hampered. Now, in order to carry out the functions of the business, the normal operations of the business in an efficient, effective, and uninterrupted manner, the, the ascertainment of the continuous flow of capital is very important, which is ensured by finance in the economy. Again, as I have mentioned, finance is the lifeblood of business and is concerned with the provision and management of the funds for the satisfactory conduct of the business. Now, what are the roles that are played by finance? The identification and ensuring of the financial source. Okay, now if I need fund, if I need capital for my business organization, I have to identify that from which sources can I procure funds for my business organization. Now, there needs to be a choice of optimum financial structure. How would be the financial structure of my organization? Depending on the decision of the financial structure I'll choose, from which source should I raise funds for my business organization. Next is the management of long-term and current assets. Now, if I do not have fund in my business organization, what will happen? I will not be able to meet up with my liabilities. I will not be able to meet up with my long-term management goals. I'll not be able to procure any long-term assets, nor will I be able to maintain my current assets. If I am not able to maintain my current assets, the normal operation of my business organization will get hampered. So again, over here we can see a important role that finance is playing in maintaining the normal efficiency of the business. And if the business runs smoothly, then only we can say that our economy functions smooth. Furthermore, the allocation of the financial sources is also a very important factor. Now, I have acquired my funds. I have different financial sources. Now, how to allocate that decision is also very important. So, in a nutshell, we can say that the finance is indispensable for any business organization. Rather, we can say that finance is indispensable for the economy. Without finance, the entire economy will come up to standstill and we cannot make any kind of progress. So, on understanding the role of finance, let us move on to the different financial innovations and developments in the financial system. Now, when we are talking about the developments of the financial system, there are three terms, there are three things that comes up. First, there is rudimentary finance, then there is the direct finance, and third, last but not the least, is my indirect finance. Now, what do I mean by the rudimentary finance? The rudimentary finance refers to the financial mechanisms or systems that is existent in an underdeveloped economy where the per capita output is low or is declining over time. Now, if my per capita income is declining over time and my financial system is not a very developed or a very competitive one, then we can say that it's kind of rudimentary finance. Now, how do you identify that this financial system is a kind of rudimentary finance? There will be lack of financial assets or instruments. There will be not much investable opportunities for the investors. The financial markets will be inefficient. There will be inefficient allocation of the resources. Now, the spending units cannot have enough financial assets, so my savings will remain unutilized. Now, each of these spending units should have a balanced budget position with savings that equals the investments. Now, the arrangement of rudimentary finance basically leads to a low level of investment as well as of savings. Now, if there is low level of investment and there is low level of savings, it will show that the entire economic growth, the entire economic output will be comparatively lower. If there is an inefficient resource allocation, now it can never provide an encouragement to the investors for having a higher savings and for offering into the markets. Now, there are certain lacunas as we have seen in the rudimentary finance that it's almost an inefficient financial system and it is mostly prevalent in the underdeveloped economies where the per capita output is low or it is declining over time. So no one would be willing to come up to this kind of financial system. That is why there are different pitfalls that can be observed in the rudimentary finance. What are the pitfalls? Now, over here, there is lack of resources available to channelize the financial incentives to savings because there is only one or two financial assets where we can invest our funds. There is no possibility of reallocation of the savings. Now, whatever savings I have, I do not have much of the channels, I do not have much of the instruments to invest it. So my investment opportunities will be less. Furthermore, if my investment opportunities are less, if my finance are not getting channelized properly, of course, what will happen? It will make the entire tendency of savings to get lower and lower. If the entire savings of the economy are getting lower, it will lead to a lower rate of growth. And again, it will it will hamper the total development of our economy. Now, since this kind of lacunas, since this kind of pitfalls were observed in the rudimentary finance, there was a need that was observed for the direct and the indirect finance in the financial system. So let us move to direct finance. Now, what happens in case of the direct finance? Now, over here, you can see there are three segments that have been made. One is the supplier of funds, one is the financial markets, and the another one is the users of the funds. Now, who are the suppliers of the funds? the households, the business firms, the governments, the foreign investors. These are all your suppliers of the funds. Who are the users of the funds? Their funds can be used by the business sectors. The funds can be used by the government sectors. And furthermore, there can be foreign investors who are also willing to use our funds. Now, whenever we are talking about the supplier of funds and user of the funds, we need an intermediary to act as a link between the two. Now, who is the intermediary in this case? The intermediary is the financial markets. Now, the supplier of the funds, be it the household, be it the firms, be it government, be it foreign investors, they are supplying their funds in the financial markets by way of investments into the different financial assets. Now, when the suppliers of the funds are investing their money in the financial markets, so what happens? Their funds via the financial markets are getting transferred to the users of the funds. And the users of the funds are also providing something in return to the supplier of the funds. What they are providing? For example, if a household, if an individual is investing in the shares of a particular company, so the fund is moving on from the individuals to the business sectors. The business sectors will be utilizing those funds, and thereafter they will be providing some dividend on the shares to the individuals. So in this way, there is a two-way flow between the suppliers of the funds and the user of the funds, and the financial markets act as a direct link between the two. Now, this arrangement is known as your direct finance. So, what happens under the traditional mechanism? What was the traditional mechanism? It was a rudimentary finance. Over there, we have observed there are lack of financial assets, there are lack of investment opportunities, there are lack of financial resources over there, there is misallocation of the resources, and in turn, the entire savings investment process was hampered. Now, over here, there is an alternative financial mechanism, which is my direct finance. Now, direct finance is what? Direct finance is directly helping us to invest our funds. It is providing us financial assets, and the financial market, the stock exchange, is acting as an intermediary between the surplus and the deficit sectors. Now, whenever we are talking about direct finance, it has three main components. What are the three main components? The first thing is the financial assets or instruments. Next is the investment bankers or brokers. And the third thing that comes up is the stock exchange. Now, over here as well, we can see that are different financial assets or instruments where the suppliers of the funds are putting their money into. The investment bankers or brokers act as a link between the suppliers of the funds and the stock exchange. And the stock exchange, what it does, it channelizes the funds from the suppliers to the users of the funds. Now, what are the features of my direct finance? There is a scope for mobilization of my savings. Now, whenever there is financial innovation, whenever there is development, there should be some proper scope for mobilizing or transforming our savings into investments. Now, these may include your financial assets, these may include your stock exchanges, and so on. Now, what happens? Whenever we are talking about the direct finance, it cannot restrict the savings of an economic unit to invest in real assets only. So what it introduces? It introduces a different kind of financial assets so that the funds are never remaining idle with the savers. Now, the entrepreneurs can also exploit the different investment opportunities via the direct finance. Furthermore, there are non-financial economic units, okay, What does the non-financial economic units do? They mainly produce and purchase the current output, and they buy one type of securities issued by the other. Finally, under your direct finance, the economic units are able to finance the excess investments over savings, which in turn improves the allocation of the savings. Now, the question comes that is there any limitation? Is there any pitfall in case of my direct finance? The answer is yes. Now, over here as well, what happens? Now, we have heard about SEBI. What is SEBI? SEBI means the Securities and Exchange Board of India. It is one among the financial regulators. We will be talking about the financial regulators in the later part of our discussion as well. Now, there are three types of investors. One are the retail individual, one is the non-institutional, and another one is the qualified institutional buyers. Now, over here, what happens whenever we are talking about the retail individual investors or the non-institutional investors, they are one among those who are least informed investors. Okay, so now when these kind of investors are going in for investing their funds, there is a big question mark regarding the selection of the appropriate securities. That what security should I choose? Which one will be appropriate for me to invest in? What will be the diversification opportunities? Okay, now if I am having a money, if I am investing it into financial assets, there is a certain degree of risk that is involved along with it. How am I going to diversify my risk among different financial assets so as to ensure a steady return? That is also a big question mark. Now, again, if I am investing into certain kind of financial assets, whether there are proper regulatory supervisions or not, whether my portfolio is secure or not, these kind of things are really putting a big question mark in the direct finance. Now, whenever we are talking about the institutional investors, these are the large investors and they have sufficient knowledge and expertise in the domain. So, whenever they are channelizing their funds, whenever they are purchasing any kind of securities in the capital market, they have the opportunity to capitalize their experience, they have the opportunity to capitalize their expertise and knowledge, and thereby provide a proper investment opportunity. But that is not the case with our retail individual investors or non-institutional investors. Now, what happens whenever we are talking about the direct finance mechanism, there is need for any intermediary financial institutions. Okay, that is why we had to come up with another concept, which was the concept of our indirect finance. Now, what happens in case of our indirect finance? In case of our direct finance, there was no intermediary. The suppliers directly invested into the financial markets, and the money was flowing from the suppliers to the users of the funds. But in case of the indirect finance, what happens? There is a financial intermediary who is coming up. Now, who are the financial intermediaries? These financial intermediaries can be mutual funds. These financial intermediaries can be insurance companies. These financial intermediaries can be different financial institutions and any other intermediaries as well. Now, over here as well, the funds are moving from suppliers to the financial markets and thereafter to the users of the funds. But over here, the role of the financial intermediaries are immense. The funds are flowing from the suppliers. Some intermediary is coming up. They are accumulating the fund. They are channelizing the fund. And thereafter, these funds are moving from the suppliers to the users. So what happens over here? The financial intermediaries play an important role. Why so? Because they are mobilizing the money between the borrowers and lenders of finance. Now, the indirect finance promotes capital formation because it provides the benefits in terms of divisibility, flexibility, and maturity of securities. Now, especially the small investors, the retail investors who are unaware of the fact that where they should invest their funds, how to diversify their risk, how to construct an optimum portfolio, what they will do, they can take the help of any mutual fund agencies. Those mutual fund agencies can accumulate the funds from different small investors, and they will accumulate it, and together they will invest into the financial markets. Now, by divisibility, the financial intermediaries may divide into primary securities of higher value into indirect securities of lower value. Furthermore, the financial intermediaries provides flexibility that how the borrowers is going to manage their finance. What are the primary securities that will be used up? Okay, so these are the things that are the prominent features that can be observed in the indirect finance, which was not present in case of the direct finance. Furthermore, the financial intermediaries with indirect finance put small investors in the same position as large investors. Now, if you are a large investor or you are have a small investor willing to mobilize your small savings, these financial intermediaries will hold your hands and provide you the same specialized services which will enable you to channelize your savings into an investment. Now, after having discussed the rudimentary finance, the indirect finance, the direct finance, let us move on to the structure of the Indian financial system. Now, whenever we are talking about the Indian financial system, as I have mentioned in the introduction, that it is not a single activity or it is not a single agency which comprises of the Indian financial system. It is an interconnection. It is a link between the different kind of activities, the different kind of agencies, the different kind of intermediaries who cluster around, who combine, who interrelate among themselves to form the entire financial system of our country. Now, at first, let us look into the first thing, that is the regulatory bodies. Now, whenever we are talking about the regulatory bodies, they are the major backbone of our Indian financial system. If there are no regulatory bodies, the flow of the funds, the flow of finance in our economy would not have a proper channelized direction. There would be some kind of unscrupulous activities in the Indian financial system which would restrict, which would hinder the free flow of funds from the suppliers to the providers of the fund. Now, who are the regulatory bodies of our Indian financial system? It is the Department of Economic Affairs, it's the Ministry of Corporate Affairs, it's the Department of Company Affairs, the SEBI, Securities Exchange Board of India, the stock exchanges, RBI, the Reserve Bank of India, the central bank of our country, IRDA, Insurance Regulatory Development Authority of our country. So together, these regulatory bodies regulate the different sectors of our economy, and thereby they are carrying on the seamless flow of funds, the uninterrupted flow of funds, the ethical usage of the Indian financial system. Next are the financial institutions and intermediaries. Now, without these financial institutions or intermediaries, the Indian financial system will be incomplete. Now, who are the financial intermediaries or institutions? The first thing, whenever we remember or whenever we talk about any financial institutions, are the banking institutions. Now, the banking institutions can further be classified into scheduled commercial banks and scheduled cooperative banks. Now, what are the scheduled commercial banks? These includes your public sector banks, these includes your private sector banks, these includes your foreign banks and other regional rural banks. Now, there are other scheduled cooperative banks as well. Now, apart from the banking sectors, there are different non-banking financial entities as well. Now, okay, am I audible?
Yes, ma'am, you are audible.
Okay,
Please continue.
okay. Now, other than the banking sectors, there are different non-banking financial entities as well. Okay. Now, what is the basic difference between the banking sectors and the non-banking financial sectors? Banking sectors are the one who accepts deposits and grants loans. But in case of the non-banking financial entities, what happens? They are not eligible to accept deposits. They only grant loans. Okay. So now when we are talking about the non-banking financial entity, what does it includes? It includes the different non-banking financial companies. Now, what does this non-banking financial companies do? They carry out the functions of equipment leasing, the hire purchase companies, the different loan providing companies, investment companies, and there are different residuary non-banking companies. So all these comprises of the non-banking financial companies. Other than those, we have different mutual benefit financial company as well. We have different miscellaneous non-banking financial company as well. Okay. Now, other than the banking sectors and the non-banking sectors, there are different financial intermediaries such as the mutual funds. Now, mutual funds can be in form of your public sector mutual funds. It can be in the form of your private sector mutual funds, or it can be in form of your UTIs. Now, other than mutual funds, we have the insurance companies. What are insurance companies? We know that there are different companies providing the insurance services. Now, what is insurance? Insurance is nothing but a contract of indemnity, whereby the insurer is insured against any kind of risks in exchange for a premium. Now, these insurance companies give different kind of insurance policies. Mostly the insurance policies takes place in the form of your life insurance or in form of your general insurance. Other than the mutual funds and the insurance companies, we have merchant bankers, we have different stockbroking firms, we have depositories, we have different development financial institutions, and so on. So will be discussing about this in details in the later segment of today's discussion. Now, after the regulatory bodies and financial institutions or intermediaries, let us move on to the financial assets or instruments. Now, the financial assets or instruments can broadly be classified into three heads. The first is the primary or the direct instruments. Next one is the secondary or your indirect instruments. And the third one are your derivatives. Now, whenever we are talking about the primary or the direct financial instruments, it comprises of your equity shares, it comprises of your preference shares, and it comprises of your debt instruments. Okay. Now, the secondary instruments or the secondary financial assets includes your mutual funds, your insurance policies, your time deposits. Time deposits are also known as your fixed deposits, and the last one is your provident funds or your pension funds. The last classification are the derivatives. Now, what are the derivatives? Derivatives are those financial instruments which derives its value from any other financial assets. Now, whenever we are talking about derivatives, there are four different types of derivatives. One is the forward, next is the future, next is the option, and finally it is the swaps. Moving on to the financial markets. The financial markets are broadly classified into money market and capital market. Other than the money market and capital market, we have the foreign exchange markets as well. Now, whenever we are talking about the money market, it refers to the short-term markets where the transactions, where the dealings are done for any financial instrument which are having a very less maturity period. What are the instruments that gets traded in my money market, that gets exchanged in my money market? It can be the call market. It can be the T-bills market. What are the T-bills market? T-bills means the treasury bills market. Next is the commercial bills market, commercial papers, certificates of deposits, and so on. Whenever we are talking about the capital market or the securities market, this refers to the long-term investments market. Now, over here, it is in the capital market that the tradings are done for the equities, the tradings are done for the derivatives, and there are different long-term debt markets as well. Now, in the view of my equity markets, there is two broad classification. The capital market further gets divided into the primary market and the secondary market. What do I mean by the primary market? Primary market means the new issue market. Whenever a share is getting issued for the first time, it is getting issued in the primary market. I'm sure that you all have heard about IPO. What is an IPO? IPO is an initial public offering. So wherever the shares of a particular company gets issued for the first time, it is getting issued in the primary or the new issue market. Second time onwards, whenever there is a buying and selling of the already issued shares in the primary market, that takes place in the secondary market or the stock market. Now, after the financial markets, let us move on to the financial services. Now, financial services can again be classified into two categories. One is the fund-based services and another one is the fee-based services. Now, whenever we are talking about the fund-based services, it can include your leasing and purchasing, your venture capital, your factoring, housing finance, your credit cards, bill discountings, and so on. But whenever we are talking about fee-based services, what it includes, for example, mutual funds, it includes different asset securitization, it includes different credit rating agencies. Now, whichever services are provided in exchange of a fee, in exchange of a charge, that comes up under your fee-based services. Now, whatever services are coming up with a pre-acquired fund before rendering the services, that is coming under your fund-based services. Now, yes. Now let us have a snapshot of the entire structure of the financial system that we have discussed for so long. We have regulatory bodies, We have financial institutions or intermediaries. We have the financial assets or instruments. We have the financial markets, and we have the different financial services. Now, with this, let us move on to a detailed discussion for each of those. Let me stop sharing and again I'll share it. Okay. Now the first one is the regulatory bodies. What are the regulatory bodies? The regulators ensures that the market participants behave in the desired manner so that the securities market continues to be a major source of finance for corporates, the governments, and the interests of the investors are protected. Now, if you are investing your funds in some securities, you would definitely not want your funds to get misutilized. Who will ensure that this kind of funds, this kind of investments are safeguarded? We need some regulatory bodies who will act as watchdogs for this, who will make policies of how the entire flow of funds should take place, how should the financial markets be regulated, how should the entire operations of these financial institutions and intermediaries takes place. So the entire job of policy formulation, policy execution lies with these regulatory bodies. Now, the policy formulation and regulation of the Indian financial system are made under the guidance of the Ministry of Finance, the Reserve Bank of India. Now, under the guidance of Ministry of Finance, Reserve Bank of India, all the policies, all the regulations gets drafted that how the entire banking, insurance and capital markets will carry out its operations. We have the Securities Exchange Board of India who regulates and supervises the securities markets. Now, whenever this exchange takes place in the stock market, SEBI always checks that whether it is in tune with the policies that have been formed by the Ministry of Finance and RBI or not, whether there is any discrepancies coming up or not, whether there is any unscrupulous activities that is getting noticed or not. Next, we have the Insurance Development and Regulatory Authority, IRDA. What does they do? They regulates the insurance market. So we have a regulatory body for our stock market, which is SEBI, and we have a regulatory body for our insurance sector as well, which is the IDRA. Okay. Next, we have the SEBI. The SEBI is the apex regulatory body for the securities market. Now, when this SEBI started its operation, SEBI started its operations in 1992. Now, RBI has mandated different regulations, different provisions from time to time to safeguard the entire financial structure of our country. Now, what are the mandates that are formulated, that are forwarded by RBI? It includes the regulation of all the contracts in the government securities. It relates to the gold related securities. It relates to the money market securities. So RBI has formulated a wide range of policies, a wide range of regulations to regulate almost all the activities that are there in the Indian financial system. Now, RBI not only looks after the stock exchange movements or the money market movements or the banking structures. it has framed policies for the foreign exchange management as well. Under it, there has been an act which is known as the Foreign Exchange Management Act, which came into place in 2000. And this act replaced the Foreign Exchange Regulations Act of 1973. Now, over here, currently the responsibility of regulating the securities market rests with SEBI, but the same is shared by the Department of Economic Affairs, by the Department of Company Affairs, and RBI. So we can say that the market supervision, the market regulation for our securities market is a combined regulation, a combined supervision by SEBI, by the Department of Economic Affairs, by the Department of Company Affairs, and RBI. Now, it is evident that the responsibility of regulating the Indian financial system is huge, and it is discharged by the following bodies. What are the bodies? Department of Economic Affairs, Department of Company Affairs, the Reserve Bank of India, Securities Exchange Board of India, the stock exchanges, and IRDA, the Insurance Development and Regulatory Authority. Now let us discuss about the financial institutions or intermediaries in details. So at first we have our banking sectors. In my previous discussion, I have mentioned who are the banking sectors or what are the banking sectors. Banking sectors are those sectors which accepts deposits from the public and grants loan to the public. Now, over here, there were initially 6 private banks and that were nationalized in 1980s. Now, what are the banks that were nationalized? It included a huge range of banks which converted themselves into private banks and were again nationalized by the government of India. Now, whenever we are talking about the scheduled banks, what are the scheduled banks? Scheduled banks are those banks that are included within the schedules of the RBI. Now, the scheduled bank in India comprises of your scheduled commercial banks and your scheduled cooperative banks. The scheduled commercial banks forms the foundations of the financial systems. Now, scheduled commercial banks are carrying on a major chunk of the entire financial aspects for the banking sectors nowadays. There are more than 80,500 branches for the scheduled banks, and the scheduled banks are having 4 types. What are the types of your scheduled banks? It can be your public sector banks, it can be your private sector banks, it can be the foreign banks, and it can be the regional rural banks. Now, what are the public sector banks? The public sector banks are the banks that are regulated by the government sectors. The private sector banks, of course, as the name suggests, it is regulated, owned, controlled by the private sectors. Foreign banks, now there are different foreign banks coming up in India, establishing their branches over here in India and carrying out the financial activities, the banking activities over here in India, and they comprise of the foreign banks. Now, to give an example of the foreign banks, we can talk about the Standard Chartered Bank and so on. Now we have the different regional rural banks. What are the regional rural banks? In the different rural areas, we have some small banks that have been established, and these banks are serving as a connection between the inaccessible areas. There are areas which are still not under the arena of the commercial banks. In those kind of areas, these kind of regional rural banks provide the banking facilities. Now, moving on to the non-banking financial entities. As discussed, once again, the non-banking financial entities do not accept deposits. They merely provide the loans to the one who need the funds. Now, these kind of non-banking financial entities can be partially or wholly regulated by RBI. Now, there are certain companies which are coming up entirely under the governance of RBI, and there are some which are not coming under the direct governance of RBI. Now, it comprises of your NBFCs, which are providing some specialized services. There are some mutual benefit companies, and there are certain miscellaneous non-banking companies as well. Now, let us discuss about some of the non-banking finance companies which are under the governance, under the supervision of RBI. Now, as per the section 45 of the RBI Act of 1934 and as amended in 1997, there are different NBFCs which are governed by RBI. What are those? It can be equipment leasing company. What is their primary function of equipment leasing company? They are giving up their assets, they are giving up their equipments for lease for a long time. Okay. Now, if those companies are leasing out their equipments for a long time, it also happens, it also takes form of some kind of long-term finance that they are providing. Next is the hire purchase finance company. What happens over here? Under the hire purchase agreement, the particular asset is handed over to the another person, but the ownership does not entirely pass on to the one to whom the asset is provided. They pay the amount of the particular equipment, of the particular asset on an installment basis. And only after the payment of the final installment, they are given the ownership of the asset. Now, that kind of arrangement comes up in the form of hire purchase company, and these kind of finance companies also come under the genre of your non-banking financial companies. Next, we have the loan companies. What are the loan companies? The loan companies provide loans as the name suggests. Next, we have the investment company. Now, the investment company deals with the different stakeholders, different dealers who want to channelize their funds into different kinds of financial assets and securities. Next, we have the residuary non-banking companies. Now, other than the one I have mentioned above, there may be some other non-banking financial companies which come up under the genre of your residuary or non-banking finance companies. Now, we have different mutual benefit companies. What happens over here? Under the notification of the central government, these are termed as your Nidhi companies. Now, these companies are formed for mutual help, for mutual benefit of the members of such companies. Now, there might happen that there is a requirement of loan for a shorter amount. If a person reaches up to a bank for acquiring that money, the banks might not give that money, might not give the small money to that particular person. So in that case, what happens? They can approach to these kind of companies, they can approach to these kind of non-banking finance companies that they will be provided with the funds to meet up their immediate requirement. Now, under these companies, they do not have to provide as much interest as they are providing, for example, in a bank. Okay, so these kind of mutual benefit finance companies are also gaining a popularity nowadays. Next, we have mutual benefit companies. Now, these works in the lines of Nidhi companies, but is not declared as the Nidhis by the central government. So that's the reason that we have bifurcated between the mutual benefit financial companies and mutual benefit companies. In case of the mutual benefit financial companies, it has been notified by the central government as a Nidhi company. But The mutual benefit companies, on the other hand, are working in the same tune but has not been declared as a Niti company under the guidance, under the declarations of the central government. Next, we have different miscellaneous non-banking companies. Now, the miscellaneous non-banking companies are the cheat fund companies which are engaged in managing, conducting, and supervising as a promoter, foreman, or agent in any transaction or arrangement. Now, they enter into agreements of a definite number of subscribers, and each of the subscribers provide a certain sum of money if for installment or in lump sum, and that fund gets invested for a definite period of time, and in turn, after the maturity, after the tenure is over, they are provided a certain sum of interest along with their principal amount. So this kind of miscellaneous non-banking companies are also working as NBFCs in the Indian financial systems. Okay. Now let us move on to the other financial institutions that are there. Now, the other financial institutions, mutual funds can be one of them. Now, under your mutual funds, we have the UTI, we have the public sector mutual funds, and we have the private sector mutual funds. Other than that, we have different insurance companies. I have mentioned it. We have the life insurance companies, we have the general insurance companies, we have different merchant bankers, we have different stockbroking firms, depositories, and we have the development financial institutions as well. Now, whenever we are talking about the development financial institutions, they are categorized into three broad heads. Now, what are the categorizations for the development financial institutions? It can be an all India financial institution, it can be a state level institution, and it can be any other institution. The purpose of these institutions is to provide funds for any kind of developmental activities of our economy. Now, there are different kinds of all India financial institutions as well. What are these kind of all India financial institutions which comes under the broad genre of my development financial institutions? We have IDBI. What is IDBI? It's the Industrial Development Bank of India. The purpose of IDBI is to provide fund for the industrial development of the country. We have IFCI, we have ICICI, we have Industrial Investment Bank of India, we have different small industries development bank, we have housing banks, we have agricultural and rural development banks, we have Exim banks. Exim banks are the export-import banks. The main purpose of having these banks is to give a thrust to the import and export structure of our country, to give a thrust to the foreign trade of our country, so that the foreign trade can take place in an uninterrupted manner. There are different unit trust of India, there are life insurance corporation of India, and there are different infrastructure development financial companies as well. Now, let us come up to the different financial assets and instruments. Now, these are the very important part of the Indian financial system. Why so? Because they provide the opportunity, they provide the source, they provide the link where I am able to invest my savings into. In absence of the financial assets or instruments, my savings would never have been channelized into investments. Now, whenever we are deciding on any kind of financial assets or instruments, we have to keep in mind the two factors. One is the marketability of the securities, and another one is the liquidity of the securities. Whenever we are deciding on choosing any particular financial asset, we should at first ascertain the liquidity. If I am willing to get money the next day, will I be able to get the money from those kind of financial assets or not? If I plan that, okay, I do not want the funds immediately on the next day, and I'm okay in investing my money for a longer period of time. So then I will choose my financial assets in a separate manner. But if I am looking for immediate conversion into cash, then I would choose my financial assets in a different manner. So, keeping the marketability and liquidity in mind, the investors should choose that which of the financial instruments will be best suited for their purpose among the different financial assets. So, with this, let us have a look at the different financial assets that we have in the Indian financial systems. Okay. Now, the first is the direct or the primary instruments. Under it, we have the equity shares, we have the preference shares, we have the debt instruments. Now, what are the equity shares? The equity shares are the ordinary shares of a particular company. Whenever we talk about the equity shares, we say that the equity shareholders sink and swim with the company. Okay, the equity shareholders are considered as the real owners of the company. They have control over the management of the company. They have voting rights. They have a say in the entire decision making process of the business organization. Now, these equity shareholders are eligible to get a dividend on the amount of profit that has been earned by the company. But the equity shareholders do not enjoy any preferential. The equity shareholders will get their repayment of money in case the company gets dissolved at the end. Whenever we are talking about the equity shareholders, if the company is facing a loss, the equity shareholders will not be getting their dividend in that case. So what happens? The liability of the equity shareholders is the value of the unpaid value of the shares. Since the equity shareholders are having a right to participate in the decision making of the business organization, they are having the voting rights. They are considered as the owners of the company as well. Now, let us talk about the preference shares. Now, what are the preference shares? Preference shares are those shares which are having some preferential rights. What kind of preferential rights are enjoyed by the preference shares? They are getting dividend prior to the equity shareholders. If the company is liquidating, at the time of liquidation, the preference shareholders has the right to get the return of their capital before the equity shareholders are getting paid off. At the same time, the preference shareholders do not have a voting right, but their amount, the amount that is invested in preference shares, is redeemable after a fixed period of time. Now, as per the latest notifications, only the redeemable preference shares are getting issued. Irredeemable preference shares are not getting issued. Now, if we are looking again to the equity shareholders are not enjoying any of these preferential rights, but they are having the right to get the residual profit. What do I mean by the residual profit? If, for example, in a particular year, the company has made a good amount of profit, and after paying off all its outside liabilities, after paying off the dividends of the preference shares, there is a residual profit that is lying in the company. The right to participate in the residual profit is with the equity shareholders and not with any other class of shareholders. So that is again a right, that is again a privilege that is enjoyed by the equity shares. But this should be kept in mind that whenever we are talking about equity shareholders, we are talking about those class of shareholders which sink and swim with the company. If the performance of the company is going good, these shareholders will be in a really profitable position. But if the company is not performing well, the entire position of these equity shareholders will not be a very steady one. Next, we have the equity shares with differential rights. Now, again, as per the section 43 of the Companies Act, it has given the right to issue equity shares with differential rights to dividend, voting, and otherwise. So, there are some class of shares which have a certain amount of rights, and there are some class of shares which have a different kind of rights. Moving on to the debentures. What are debentures? In one word, we can say that the debentures are the loan instruments. Now, whenever a company seeks to raise a loan, seeks to raise some kind of money from the public, they can issue debentures to the public. So, in case of a debenture is an acknowledgement of the debt that a company takes from the individuals. Now, the debenture is issued under the company seal, which shows that the company has taken a certain amount of debt from a certain person, and that will be repaid after the expiry of a certain number of years. Now, debentures are mostly issued in form of charge of any asset. Okay. Now, whenever a company is issuing debenture, it might happen that there is some asset of the company which is held as a charge in lieu of the issue of the debentures. Now, debentures or the bonds are the debt instruments of the company, and these are mostly used for raising some long-term funds for the company. For example, if a company needs funds for 5 years, for 10 years, for 15 years, so it can raise its funds through debentures, and after the expiry of 10 to 15 years or maybe 20 years, so that money gets repaid to the debenture holders, and the debentures gets redeemed after the fixed period. Now, all those we were talking about the direct instruments or the primary financial instruments. Other than these, we have the different indirect instruments or the indirect financial assets. Now, what are those? It can be your mutual funds, insurance policies, time deposits. Now, we have talked about mutual funds. What are mutual funds? Mutual funds are a pool of the assets that are created by accumulating the funds from the different small investors. So, funds or savings from different individuals are accumulated, and thereby the fund managers of the mutual funds channelize their funds into some kind of investments. Insurance policies, for example, if you're taking a life insurance policy and it gets matured after n number of years, so on the premium, on the principal amount that you have invested for your insurance policy, you get some kind of interest, you get some kind of enhanced return in your insurance policies. Then we have the time deposits. Time deposits are the fixed deposits. We all have heard about it. So this kind of time deposits are done with the commercial banks. So whenever you are depositing any money, it is deposited for a fixed time period. For example, 5 years, for example, 10 years, and so on. And there is a fixed rate of interest that you're getting on your term deposits. Next, there are the provident funds. Next, we have different pension funds as well. Now, when we are talking about the indirect funds, we have another instrument that is the derivative instruments. Now, what are derivatives? To put it in a simple language, derivatives are those kind of financial instruments which derives its value from other financial instruments. The most common example in explaining derivative comes up the example of milk and paneer. Now, paneer is what? Paneer is a product that is made out of milk. So it is a derivative form of milk. So whenever we are talking about derivative instruments, be it forward contracts, be it future contracts, be it option contracts, or be it swaps, these all derive its value from any of the underlying financial assets. These derivatives do not have their independent value, and their value entirely depends upon the price, upon the state of its underlying asset. Now, what do I mean by the forward contracts? Now, under the forward contracts, there are two parties who enter into an agreement for buying and selling a specific asset at a specified point of time in the future. Now, what happens in case of future contract? Future contract is also a form of your forward contract whereby two parties come up to an agreement of buying and selling a specified asset at a specified point of time in future for a predetermined price. But in case of your future contract, it is done in a form of a standardized manner. We have an intermediary, we have the stock exchange in between, which acts as a guarantor that this kind of contract will actually get executed. And the risk of counterparty risk is very less in case of the future contract, which is very high in case of your forward contract. Next, we have the option contracts. What are the option contracts? Now, option is the right to buy or sell any kind of asset at a stated price at a stated date. Now, the maker of the option is known as an option writer, and the holder of the option is known as the option buyer. Now, if you are buying an option, it is known as a long position, and at the same time, if you are selling an option contract, it is known as a short position. Now, depending on the market positions, the buyer or the seller decides how to execute their option contracts. Finally, there is a swap contract. What is a swap? Swap is also an agreement between one or two parties to exchange the stream of cash over a time in the future. Now, again, the swaps can take place in form of two types. One is the interest rate swaps and another is the currency swaps. Next, coming up to the financial markets. Financial markets broadly classified into money market, capital market. Whenever we are talking about money market, it is basically the short-term market, which is less than a year, at most a year. Why is this market essential? It meets up the short-term requirements of the borrowers and it provides the short-term funds to the lenders. Now, whenever we are talking about the money market, it is a place where the short-term surplus funds of the lenders gets converted into some kind of financial avenue, financial source for the borrowers for a shorter time period. Now, again, over here, when we are talking about the money market, it can be categorized into your organized market or your unorganized money market. So, the organized money market is governed by some regulatory bodies, whereas the unorganized money market is not governed by any of your regulatory bodies. Now, there are certain instruments for our money markets as well, such as the call money, your commercial bank, your treasury bills, your certificate of deposits, and so on. Now, if we are talking about the organized money market, it can be your indigenous bankers, it can be your money lenders. The ones that we can see in the rural areas, lending of money without any formal documentation, without any formal regulations, policies, or under a formal contract. Now, next, let us move on to the capital markets. Now, capital markets, as I have discussed when I was discussing the entire structure of the Indian financial system, it is divided into two broad categories. One is the primary issue market and one is the secondary market. The primary market is one where your initial public offerings are done. Wherever the new securities are coming up in the market for the first time, it is issued in your primary market or your new issue market. And whenever you're already issued shares are getting issued from second time onwards. Whenever the buying and selling of your securities takes place, it comes up in the form of your secondary market, where your further public offerings or follow-up offerings are done. In the secondary market, the entire buying and selling takes place. So this market is also known as your aftermarket, or popularly the stock market or the stock exchange, where the entire buying and selling of the securities gets regulated. Now, whenever we are talking about the primary market and the secondary market, another market also comes up, that is the foreign exchange market. Now, this foreign exchange market is also known as your multi-currency market. Over here, the exchange of different currencies takes place depending on the exchange rate that has been fixed up in the forex market. We have a dealing, we have an exchange of different currencies over here. Now, in the Indian market, we have a number of instruments in the forex market as well. For example, we have the FX swaps, we have the forwards, we have the currency options, we have different exchange traded currency futures, and so on. So, overall, the Indian financial system is having a very conducive financial markets, which comprises of your securities market, which comprises of your money market, which comprises of your foreign exchange market as well. Now, there are different long-term debts which can be taken place in form of some long-term loans or in form of your debentures, and there are derivative market where the trading of your futures, forwards, options, and swaps takes place. Now, the question comes that why should an individual invest in derivative and not in the shares directly? Right. So over here, there is a clear answer that whenever we are talking about the derivative market, it helps in transferring the risk from the risk averse person to the risk oriented people. Whenever we are having a derivative market, it helps us to discover the future as well as the current prices. Now, depending on the current prices and depending on the expectations of the future prices, we decide to enter or not to enter in any of the derivative contracts. So, whenever we are talking about the derivative market, it is basically acting as a catalyst for the entire entrepreneurial activity of our economy, and in turn, it increases the rate of savings and investments in the long run. Coming up to the last phase, that is the financial services. The financial services are broadly classified into two ways. One is the fee-based services, and the another one is the fund-based services. The fee-based services, any services which are done in exchange of some financial consideration, is known as your fee-based service. And fund-based service means, for example, you have to acquire your funds before you're providing your services. What are the major fee-based services? It can be your issue management services. It can be any advisory services. It can be any credit rating services, and so on and so forth. What can be your fund-based service? It can be your factoring services. It can be your bill discounting services. It can be your venture capitals. It can be your leasing. It can be your hire purchase, and so on. Now let us come up to the last phase of our discussion, that how the financial system is related with the economic development of India. We have discussed about what is financial system, the history, the structure, the importance of finance. But the question remains that how this financial system is ultimately leading to the fulfillment of our entire objective of economic development of our country. This can be elaborated with the diagram. Now, what over here we can see is that there is a surplus unit, there is a deficit unit. The financial system acts as an intermediary, acts as a link between the surplus and your deficit sectors. Now, whenever we are talking about the surplus spending units, these are the lenders of your funds. What happens over here? What is the surplus that is getting invested? It is basically your income, less your consumption expenditure, and less your planned investment. So whatever income is remaining in your hand, which is in form of an investable fund, that is what we call as your surplus. So when your income is greater than your consumption and planned investment, it becomes your surplus amount. This surplus amount is getting transferred to the deficit spending units. Now, whenever we are talking about the deficit units, they are not having the sufficiency of the funds. Why so? Because over there is lesser amount, or perhaps there is no amount left after the allocation of the consumption and planned investment from the total income. So over here, what happens? An interaction needs to be set up between the surplus spending units and the deficit spending units. So we can see over here that the funds are getting flowed from the surplus spending units in the financial system. Through the financial system, the funds are getting channelized to the deficit financial units. Next, from the deficit spending units, again, there is flow of securities. Of course, if I am making my funds, if I'm investing my funds in certain securities, of course, the security flow will come up to the surplus spending units. So, from the surplus units to the deficit spending units, there is the flow of funds. And again, from the deficit spending units to the surplus spending units, there are the flow of the securities. Now, this financial system was all that we were talking about for so long. It comprises of your regulatory bodies, institutions, financial assets, financial markets, and your financial services. The entire structure interrelates amongst themselves to lead to the capital formation of our economy. If there is capital formation of our economy, the business sectors are having the funds to carry out their production activity. If the business sectors are carrying out their production activity, the gross domestic production of the entire country will increase. If the gross domestic production of the country increases, then we can say that the national income of the country increases. If the national income of the country increases, the per capita income also increases. If the per capita income increases, the standard of living of the people also increases. If standard of living increases, then we can say that the overall economic welfare gets ensured. So everything starts with the concept of your capital formation. If there is no capital formation, there is no question of economic growth. There is no question of economic development. So the entire structure depends on the flow of funds, the financial system, the capital formation, and the economic development. So this was all about the Indian financial system, how there is different interactions among the different sectors, how are those interrelated, and how it is ultimately leading us to the fulfillment of our ultimate goal of attaining economic development. So with this, I want to thank you for your patient hearing, and I want to conclude my session over here. Over to you, sir.
Thank you so much, ma'am. It is really nice session, and students will clearly understand the basic needs of the financial management and how they can solve the problems in their daily lives. Thank you so much, ma'am, for your valuable time out of your busy schedule. Thank you so much, ma'am.
Thank you for the opportunity. Thank you so much.
Thank you so much, ma'am. We are concluding